Think giving your house to your kids magically avoids inheritance tax? Let's clear that up.
People swear this lets their family totally dodge HMRC tax bills. Spoiler alert, it doesn't.
Fall for this trap, and your family gets slapped with a brutal 40% tax hit.
It's called a gift with reservation. Basically, you gave it away but still live there rent-free.
Because of that, HMRC literally ignores the gift entirely. It stays right in your taxable estate.
The only real fix here? You actually have to pay your kids full market rent.
Want to master these ATX traps and absolutely crush your exam? Download my notes right now.
Okay, let's jump right into a rapid-fire ACCA MA exam hack for mixed costs. Struggling to separate semi-variable costs? Yeah, those mixed cost exam questions are literally the worst. Here's the hack. Separate fixed and variable costs by dividing the cost difference by the activity difference. But major warning here, always pick your data based on highest activity, never highest cost. Don't fall for that trap. Grab my paid MA notes right now to guarantee exam success. Stop right there. Do not restate those depreciation changes. It's a massive exam trap. Fall for this and you score a 0. Seriously, so many students fail this specific FR rule. The secret to passing, you've got to remember depreciation is literally just an accounting estimate. Since it's an estimate, you only apply the change prospectively. No going backwards, guys. This is absolutely crucial. Why? Because accounting policies require a full retrospective restatement. Imagine a classic exam scenario. What if we're changing the useful life from 10 to 5 years? You might totally want to restate past financials, but wait, here's the catch. To secure those marks, apply it only from the current year, never, ever earlier. Ace it and download my paid FR notes today. But could companies use this prospective rule to manipulate earnings? Here's the IAS 36 trap. Never use undiscounted cash flows to calculate value in use for asset impairment. You absolutely must always discount the future cash flows straight to their present value. Seriously, do this, or your entire calculation is going to be completely wrong. Want to pass? Grab my paid FR notes right now. Let's dive right into the ultimate ACCA SBR exam trap. We're talking IFRS 3 step acquisitions. So you hold 30% of a company, then buy 50% more. What happens to old shares? You've just hit an 80% controlling stake. But how on earth do we account for that? Here's the massive trap. Most students just carry over the original cost. Please do not do this. First, identify your initial stake. Then, crucially, you've got to remeasure it to today's fair value. Next up, calculate the new goodwill. Finally, recognize any hidden gains right in profit and loss. Let's put some numbers to it. Say your old 30% stake originally cost $300, but on today's acquisition date, the fair market value of those shares jumped to $450. Now, to grab control, the parent company pays $800 for that extra 50%. And the fair value of the subsidiary's net assets right now? Exactly $1,000. Time to calculate goodwill. Add the old stake's fair value directly to that new consideration. That's $450 plus $800 minus $1,000, leaving us exactly $250 in goodwill. But here's the real secret. Remeasuring those old shares actually triggers a massive hidden gain. Just subtract your old $300 cost from the new $450 fair value. Boom, $150 gain, and it has to go straight to profit and loss. Why? IFRS 3 treats that initial stake as sold and repurchased, so no OCI reclassification. If you remember one thing today, step acquisition means you remeasure old shares, gain to P&L. We've totally mastered gaining control. But what happens to the accounting when you lose control instead? Welcome to This Explainer. Today, we're doing something uniquely powerful. We're using a dual iterative learning framework to master both the economic reality of inflation and the professional, high-level English you need to discuss it confidently in any corporate setting. Think of this as a bridge from the everyday world you know straight into the boardroom you want to command. All right, let's look at our roadmap. We're hitting 1. The plaid shirt story. 2. Erosion of purchasing power. 3. The macro view of central banks. 4. Monetary policy and QE. 5. CPI and measuring the impact. And finally, 6. A shadowing practice for financial fluency. Let's jump right in. Section 1. The plaid shirt story. To really understand high finance, we have to start at the micro level. Let me introduce you to Lisa. She's a young professional who has her eye on a really cute plaid shirt. She watches it for several months, planning to save up. But to her complete frustration, the price of that exact same shirt steadily increases month after month. Meanwhile, her salary, completely unchanged. It's literally the exact same piece of fabric, but it demands way more of her labor to acquire it. And this perfectly captures the silent nature of inflation. It sparks that incredibly relatable frustration of seeing the cost of living rise. It reduces the real value of your income without ever visibly changing the dollar amount printed on your paycheck. You don't see a pay cut, but you absolutely feel a pay cut at the register. Section 2. Erosion of purchasing power. Let's elevate this narrative from Lisa's personal frustration directly into a broader economic concept. Through Lisa's eyes, we're seeing what economists call the erosion of purchasing power. Purchasing power is simply your financial ability to buy products and services. When prices go up, that power silently erodes. It means her money just doesn't go as far as it used to. It's essentially an invisible tax on her wallet. Now notice how we can map Lisa's casual, everyday expressions directly to the high-level jargon used by institutional analysts. When Lisa says, "The shirt costs more now," a CFO says, "There is inflationary pressure on consumer goods." When Lisa complains, "My money doesn't go as far," an economist notes the erosion of real income. It's the exact same reality, just expressed with a completely different level of professional authority. Section 3. The macro view. Central banks. We are now officially stepping out of the shopping mall and into the boardroom. We need to look at the massive macroeconomic forces at play behind that price tag. Financial executives aren't just looking at shirts, they're looking at institutions like the Federal Reserve, or the Fed. This is the central banking system responsible for managing monetary policy, crunching inflationary data, and tweaking interest rates to keep the economy stable. They control the levers that ultimately dictate Lisa's purchasing power. To understand how intense these forces can get, just listen to legendary investor Warren Buffett. Discussing recent economic conditions, he pointed out that we've never really seen what happens when you shovel massive amounts of money into the economy on a fiscal basis, while simultaneously keeping a monetary policy of near zero interest rates. That unprecedented combination acts as a massive stimulus, but as a consequence, it drives up prices across the entire board. Section 4. Monetary policy and QE. The crucial piece of the puzzle here is understanding the specific tools these institutions use to manage, or sometimes unintentionally overheat, this economic environment. A big one you'll hear in executive circles is quantitative easing, or QE. This is a monetary policy where central banks buy predetermined amounts of government bonds to inject massive amounts of liquidity, basically cash, directly into the economy. It acts as a powerful stimulus, making borrowing cheaper and encouraging spending, but it can heavily influence inflation because you've got more money chasing the exact same amount of goods. Here's how the cycle typically plays out. First, central banks evaluate capacity utilization and track inflationary data. Second, they execute open market operations, like QE, to inject that liquidity. But third, when inflation runs too hot, when that plaid shirt gets entirely too expensive, they have to reverse course. They apply monetary tightening, usually by raising interest rates, to cool things down. For a finance leader, tracking these institutional steps is absolutely crucial. It tells you when to anticipate EBITDA margin compression or when you need to trigger OPEX optimization to protect your company's bottom line. Section 5. CPI, measuring the impact. To measure whether these macro policies are actually working, the financial world relies on very specific indices. They need hard data to prove what Lisa's feeling. Enter the Consumer Price Index, or the CPI. This is the boardroom's official way of tracking exactly what Lisa noticed. The CPI examines the weighted average of prices for a basket of everyday consumer goods and services. Everything from transportation and food to, you guessed it, apparel. When the CPI goes up, purchasing power is officially going down. And what drives the CPI up? As top executives are constantly noting, fundamental pressures and scarcity in raw materials are major culprits. When you have surging timber prices, rising steel costs, or intense petroleum input pressures, those costs don't just vanish. They flow directly through the global supply chain, jacking up the cost of manufacturing and shipping, and eventually landing right on the price tag of consumer goods.
Section 6, Shadowing Practice for Financial Fluency.
Now it's time to put all of this into practice. For our final segment, we're going to use an auditory shadowing technique. You are going to act as my echo. This is how you master the prosody, rhythm, and intonation of authoritative professional English. I'll read a CFO-level phrase, and then I'll pause. During that pause, I want you to speak out loud and echo the phrase. Mimic my pacing, my stress, and my intonation. Then I will repeat it one more time so you can hear it again. Ready? Let's build that muscle memory. There is significant inflationary pressure on consumer goods. There is significant inflationary pressure on consumer goods.
All right, let's try the next one. We are actively monitoring the erosion of real income. We are actively monitoring the erosion of real income.
Last one, nice and strong. The central bank is utilizing monetary tightening to curb inflation. The central bank is utilizing monetary tightening to curb inflation. Excellent work. By doing this, by bridging the gap between orthography, what you read, and phonetics, what you actually say, you are building true automaticity. This is the critical skill required to drop sophisticated terminology in high-stakes presentations and negotiations without that clumsy hesitation of translating in your head. You're just speaking the language of leadership naturally.
I want to leave you with a final thought to take back to your own boardroom. Consider this as you take your newly honed vocabulary out into the real world. As central banks inevitably shift toward monetary tightening to curb inflation, how will these macroeconomic forces compress margins in your specific industry tomorrow? Will you be ready to explain it to your team? Thanks for joining me for this explainer, and I challenge you to start applying this framework today.
Watch out, it's literally the silent thief destroying your money.
You know, Lisa couldn't even afford her favorite plaid shirt because of inflation.
But in the corporate world, you absolutely must track how the Federal Reserve uses monetary policy
And quantitative easing to directly control the consumer price index.
So, is it demand or the Fed? Grab my paid finance notes to pass.
Welcome to the explainer. So why might a perfectly executed physical inventory count actually be totally useless?
You counted every single box, right? But does that actually mean your financial statements are accurate?
Nope. Physically seeing a box means literally nothing if late deliveries hit the wrong financial period.
Enter the magic of cutoff. It's what bridges the gap between physical reality and financial accuracy.
Auditing standard ISA 501 says auditors must attend the inventory count, doing so in 3 phases.
Before, we plan. During, we observe. But that crucial after phase, that's where we check cutoff.
To test this out, auditors rely heavily on goods received notes and dispatch notes.
Want top exam marks? Always use active verbs like inspect or observe for your audit procedures.
First, grab those last pre-year-end notes. Then, trace them to ensure they're actually included in inventory.
If goods showed up before year-end without an invoice, you still got to include them in accrue.
Finally, test that sales cutoff. Make absolutely sure pre-year-end dispatches are actually recognized as revenue.
So your golden rule to remember, cutoff simply means matching goods to the correct accounting period.
Master audit and assurance with my paid notes. And ask yourself, could one missing note distort everything?
First-year audits often hide massive prior mistakes. Let's dive into the dangerous ISA 510 trap.
Under ISA 510, you absolutely got to verify those opening balances immediately. It's totally critical. But if you didn't audit the prior period, how exactly do we prove those balances? Your first move? Check the previous working audit papers or just agree them to prior financial statements. Alternatively, you can always test current year transactions, or honestly, just review the prior year's minutes. But hey, here's the catch that AA examiners absolutely love to use as a trap. Unverified opening balances will literally ruin the current year. You just can't build on a faulty foundation. So look, if you lack sufficient evidence, you've got to immediately modify your opinion. No exceptions. Depending on the impact of that missing evidence, you're issuing either a qualified or a disclaimer opinion. Here's the breakdown. Material but not pervasive, that's qualified. Pervasive? Yeah, that requires a full disclaimer. So here's your golden rule. Verify those opening balances or immediately modify your opinion. Want to avoid this trap? Download my paid AA notes today and absolutely crush your exams.
Can following all the rules actually make you the bad guy?
Yep. A business can follow the law exactly as it's written, but still be totally unfair. Legal just means ticking boxes. For your exams, remember this. Ethics go way beyond the law. But here's the catch.
Hiding bad product info from your customers? That's technically legal.
But it's highly unethical and completely destroys their trust. Don't lose easy exam marks. Watch the full explainer now.
Welcome to this explainer. Okay, today we're stepping into an absolute masterclass. We're going to examine the philosophy of a literal financial legend and, use his life's work to seriously sharpen our own professional vocabulary and our investment mindset. Let's get right into it. So, here's our quick roadmap for today. We'll start with the philosophy of long-term growth, move into iteration A, which is the biographical narrative, then iteration B for the technical analysis, explore the cash fortress strategy, and finally, we'll wrap up with a dual iterative shadowing practice. All right, Section 1, Iteration A, Biographical Narrative. So, when we talk about the early days of Warren Buffett, affectionately known as the Oracle of Omaha, it's pretty fascinating. In the 1930s, right in the thick of the Great Depression, his wealth building didn't kick off in some fancy corporate boardroom, right? It actually started with basic newspaper routes and selling sodas. Then, fast forward to the 1950s, he studies under the legendary investor Benjamin Graham at Columbia University. That's really where he laid down his intellectual foundation. And by 1965, he acquires a struggling New England textile firm named Berkshire Hathaway. It's just incredible mapping this rise from a modest kid with a paper route to the architect of a powerhouse global conglomerate. Now, you really have to consider his profound evolution as an investor here. Benjamin Graham's early method, which was known as cigar butt investing, was all about scooping up struggling, deeply undervalued companies on the cheap. It was literally like finding a discarded cigar on the street that still had one good free puff left in it. But over time, Buffett's approach completely shifted to value investing, which means buying high-quality businesses at fair prices. He realized that holding on to fundamentally strong companies creates this incredible virtuous cycle of long-term compounding growth. It was a total game changer. And that shift to value investing? It was heavily influenced by his lifelong partnership with Charlie Munger. Munger really served as his strategic compass. But here is the kicker. Despite building immense, mind-boggling wealth, Buffett lived in the exact same Omaha house for over 60 years. I mean, who does that? Plus, he's pledged 99% of his wealth to philanthropy. It goes to show how his modest history genuinely forged a community-focused culture that still defines the entire company today.
Moving right along to Section 2, Iteration B, Technical Analysis.
Let's actually translate that biographical narrative we just talked about into professional implementation. It's like a giant puzzle coming together. That idea of buying quality at a fair price, that scales up into intrinsic value analysis. A folksy story about 4 friends at a Dairy Queen translates into the intense reality of managing a $500 billion portfolio. And that fact about living in the same house for 60 years, well, that evolves into the highly strategic maneuver of holding cash amid sky-high valuations. It perfectly demonstrates how personal patience and discipline directly scale up to manage multi-billion-dollar realities. Let's really zoom in on one of those key terms, intrinsic value. This is the calculated true worth of a business based on fundamentals, operating earnings, and enduring competitive advantages, what Buffett famously calls economic moats. To fully grasp the logic of Berkshire's leadership, including the current CEO Greg Abel, we absolutely have to master this concept. It's all about evaluating high-margin, capital-efficient businesses that can actively protect themselves from competitors. Okay, on to Section 3, the cash fortress strategy. This brings us to a massive historical pivot point for the firm in early 2026, and it's driven by an extraordinary, almost stubborn dedication to patience and market discipline. Prepare yourselves for this staggering figure, $382 billion. Yes, with a B. This represents the record amount of cash and treasury bills the conglomerate has just hoarded. I mean, to put that into perspective, just think about the sheer magnitude of that number. It's an absolute astronomical war chest, literally larger than the entire market capitalization of many major global corporations. Breaking that down a bit, this cash fortress now makes up an unbelievable 56% of their entire portfolio, over half.
It was largely fueled by net stock sales of massive holdings like Apple and Bank of America. Now, you might be wondering, why do this? Well, this cash pile acts as the ultimate market signal. It impartially demonstrates how they organize their entire strategy around caution, basically flashing a huge warning sign about overvalued stocks relative to the broader economy. They are simply waiting for the perfect pitch. They're holding out for valuations to finally align with that intrinsic value we just talked about before they deploy any capital.
All right, Section 4, Shadowing Practice, Dual Iterative Protocol.
Okay, let's dive into the interactive climax of this explainer. We've built the narrative, we've learned the technical terms, and now we're going to directly apply this new advanced financial vocabulary. So, I want you to focus. Listen to the financial sentence I read, and then I want you to repeat it out loud exactly 2 times to really lock in your linguistic mastery. This dual iterative method is absolutely proven to help internalize complex vocabulary. Ready? Let's do this.
Here is your first phrase. Intrinsic value analysis protects against systemic failures. Now repeat it exactly 2 times. Intrinsic value analysis protects against systemic failures. Intrinsic value analysis protects against systemic failures.
Excellent work! Now for the next phrase, which is a quote directly tied to their capital allocation strategy. We utilize share repurchases when intrinsic value exceeds the market price. Please repeat it exactly 2 times. We utilize share repurchases when intrinsic value exceeds the market price. We utilize share repurchases when intrinsic value exceeds the market price.
You are doing great. And now for our final shadowing target. The cash fortress is a market signal amid sky-high valuations. Go ahead and repeat it exactly 2 times. The cash fortress is a market signal amid sky-high valuations. The cash fortress is a market signal amid sky-high valuations. What a fantastic exercise. As we wrap up this explainer, I really want to leave you with a provocative question to chew on. Do you possess the patience to endure the cash fortress strategy in your own financial journey? Seriously, consider how mastering both this advanced vocabulary and the intense discipline of long-term growth might permanently reshape your own professional investments. Remember, sometimes doing absolutely nothing is the hardest, yet absolutely most profitable move you can make. Thanks so much for learning with me today.
Hey ACCA students, you might actually be throwing away easy marks on your SBL strategy questions.
Think about it. Why do even the most brilliant, perfectly planned business strategies completely fail?
Because culture eats strategy for breakfast. An old workplace culture will literally always crush a shiny new plan.
It's a total battle of a perfectly logical strategy going up against super stubborn human behavior.
Here's a classic exam trap for you. Even the absolute best IT systems are gonna fail.
If the human culture naturally resists that tech with old workplace rituals and stubborn stories.
SBL examiners absolutely love using the cultural web tool to diagnose these exact failures. Keep that in mind.
So what hidden cultural traps are lurking in your next case study? Watch the full explainer to find out.
Okay, let's jump right into this explainer. You absolutely cannot legally pay for past favors. Ever promised to pay someone for a favor they already totally finished? We've all been there, right? Well, surprise, under contract law, you're not legally bound to pay them a single cent. Seriously. Why? Every valid contract needs consideration. That's basically just the price you pay for a promise. Here's the deal. The law only cares about present or future value. Past actions? Nope. But here is the catch. And guys, this is a massive trap for your law exams. Past consideration is legally zero consideration. A promise made after the fact literally means nothing. To put that into perspective, let's look at the classic exam case, Reem McCardle. So family members completely finished doing house repairs and only then asked for payment. The court ruled no contract. Since the work happened before the promise, the consideration was totally invalid. Now, you might be wondering, are there any sneaky exceptions to this super strict rule? Actually, yes. Promissory estoppel, it's a rare, equitable exception where a promise actually can bind you. The famous High Trees house case perfectly shows this estoppel exception. Definitely memorize that one. Anyway, back to our main rule. Consideration must be sufficient, move from the promisee, and never be passed. Will your next promise hold up? Grab our paid PDF notes today and crush that LW exam.
So, should you make a product yourself or just buy it? Let's dive into this classic business dilemma. Sounds pretty simple, right? But watch out, because there's actually a massive profit-shrinking trap hiding here.
Say your internal variable cost is £8, but an external supplier charges 10.
Making it internally looks way cheaper, right? I mean, the math seems totally obvious.
But here's the catch. Your internal production labor, it's actually already fully occupied.
Pulling that labor away means you lose money elsewhere. We call this opportunity cost.
In our example, that lost opportunity actually cost the business £3.
You absolutely must include this. Just add your base cost to that new opportunity cost.
The plot twist? Your true internal production cost just skyrocketed to £11.
So crazy enough, internal production is now actually more expensive than just outsourcing it. This all boils down to relevant costing, which focuses only on future, incremental cash flows.
The crucial takeaway, ignore those past sunk costs, but always factor in resource scarcity.
So here's the golden rule. Make it if the internal relevant cost is lower. Otherwise, buy.
Seriously, ask yourself, what hidden opportunity costs are shrinking your profit margins right now?
Are your top performers suddenly slacking off? Let's fix that motivation crash right now. So, why the sudden underperformance? Spoiler alert, it's almost never about the paycheck. A basic salary alone guarantees nothing. What your people truly crave is esteem and personal growth. Enter Maslow's hierarchy. You're paying their bills, sure, but are you starving their higher level needs? For example, a simple team promotion works absolute wonders. It instantly satisfies that need for esteem. Watch the full explainer and grab the ACCA BT notes. What non-financial reward does your team need? Welcome to the explainer. Forget rote memorization. Today, we're mastering the ACCA Strategic Business Leader exam. So, why do students fail? Rote memorization guarantees it. The examiner wants you thinking like a CEO. Passing means just listing theory. A distinction? That's applying it to make a justified business recommendation. First up, stakeholder mapping. The crucial step is managing stakeholders effectively using Mendelow's matrix. This matrix forces you to assess stakeholder power and interest using actual scenario facts, zero guesswork. You must closely engage only with key players who have both high power and high interest. When resources are tight, focusing heavily on those key players is exactly how you secure top marks. Next, Cotter's change management. Once stakeholders are aligned, managing that transition is totally vital for implementation. These are Cotter's highly testable phases. Your job is to trace exactly which steps the scenario missed. Think of Cotter like baking a cake. You need to practically identify those missing ingredients to pass. Next is Tucker's ethical framework. Every exam has an ethical dilemma. Don't lose easy marks here. Run through these 5 lenses using the facts. Even if you reject profit, show you considered it. A balanced evaluation across all 5 of these questions will absolutely score you the highest marks. Finally, the professional edge. Technical frameworks aren't enough. You need these crucial professional marks to win. Keep in mind, there are exactly 4 professional skills the examiner explicitly looks for and marks. Challenge assumptions, consider commercial profit, break down complex info, and always weigh the pros and cons. For every single recommendation, add 1 sentence of evaluation. That literally turns a pass into a distinction. Remember, design measures that matter. So, will you write like a student or advise like a CEO? Welcome to this explainer. Let's jump right in and master that ACCA AFM exam. So, how do you actually pass advanced financial management? Let's check out expert Andrew Mauer's top strategies. First off, get comfortable with spreadsheet software. And please avoid question spotting. You've got to cover everything. It's super interesting to see how AFM really steps up the complexity from your basic financial management. While FM uses simple MPV, AFM dives deep into adjusted present value and re-gearing betas. AFM goes way beyond the basics, tackling really complex, real-world investment and financing decisions. Crucially, APV separates your base operating NPV from financing side effects, like the tax shield on debt. The formula is super logical. Base case NPV plus the present value of those financing side effects. Remember, your base case assumes all equity financing, so always discount using the ungeared cost of equity. Watch out for key side effects like tax shields on debt, issue costs, and government subsidies. So how does this work on the exam? First, calculate that ungeared cost and your base NPV. Next up, figure out the tax shield on your debt, and immediately deduct issue costs as cash outflows. Finally, add in any subsidized loan benefits. Sum the whole thing up, and boom, that's your APV. Okay, pay attention. Here's a massive exam trap you absolutely must avoid when calculating APV.
Never use WACC for your base NPV. The fix? Always use the ungeared cost of equity instead.
To crush this exam, master every single component. Practice base NPV, tax shields, and those loan subsidies. Like the revision notes say to help master AFM, you have the tools. Apply them confidently and pass. Are you ready to apply APV and absolutely dominate your exam? Go start practicing these concepts today.
Welcome back, everyone. Today, we're jumping straight into bridging a massive gap for professionals in the global economy. We are talking about that leap from just having basic language proficiency to commanding absolute financial fluency. We're going to decode the digital asset frontier, specifically Bitcoin and blockchain, and we'll be using a really powerful tool called the Dual Iterative Framework. Let's get right into it.
Look, we've all been there. Navigating complex financial jargon, especially if it's in a second language, creates this massive cognitive load, right? It is incredibly frustrating to have the strategic vision in your head, but maybe you lack that precise boardroom-level vocabulary to actually back it up. Well, today, we are going to lower that cognitive load.
Here is our roadmap for the explainer today. First up, the Dual Iterative Framework. Next, Iteration A, Freedom Money, followed by Iteration B, Technical Mechanics. Then we'll cover some shadowing drills, and we will wrap things up with actionable storytelling.
Starting with Section 1, the Dual Iterative Framework, Bridging Storytelling and Technical Analysis.
So to really master complex financial English, we don't just dive headfirst into the deep end. Instead, we use a dual approach. Iteration A starts with what we call a life literacy story, basically a human-centric narrative that gives us a solid emotional anchor. And once we've built that mental map, we pivot to Iteration B, Technical Professional Analysis. This is where we trade out that beginner story for the exact high-level jargon a CFO would actually use.
Moving to Section 2, Iteration A, Freedom Money, the philosophy of Satoshi Nakamoto. Okay, here we have a direct quote straight from the 2008 white paper. Satoshi wrote, "What is needed is an electronic payment system based on cryptographic proof instead of trust." And this just brilliantly hits the nail on the head regarding the foundational problem Bitcoin set out to solve. At its core, the beginner narrative frames Bitcoin as a peer-to-peer technology that entirely removes the need for a trusted third party, like a central bank, by relying on the hard science of cryptography instead.
If we trace this idea back to 2008 with Satoshi's white paper, through the network launch in 2009, all the way to the present day, we see a totally fascinating evolution. In our beginner narrative, this is really the story of personal freedom. It's a hedge against inflation and a structural shield against the erosion of your purchasing power.
So to sum up Iteration A, we express Bitcoin simply as digital gold. It's a private digital vault offering true censorship resistance. This narrative is great because it uses really accessible language to explain the why behind decentralized finance to non-technical audiences. It's fundamentally the story of sovereign money and personal protection.
Let's step it up to Section 3, Iteration B, Technical Mechanics, diving into the high-tech blockchain network.
Now we're zooming in. We are no longer talking about a simple digital vault. We have to master terms like UTXO, which stands for Unspent Transaction Output. You can think of UTXOs kind of like individual dollar bills in a physical wallet. They are literally the technical method used for tracking specific chunks of Bitcoin. A professional absolutely must understand coin control. For example, you need to make sure you never mix KYC coins, which are tied to your real-world identity, with anonymous, non-KYC coins. If you mix them, you permanently taint your privacy.
And this builds right into a strict privacy lifecycle. Because operating at a high level isn't just about stacking coins, it's heavily about obfuscating on-chain behavior. The playbook here is extremely precise. First, non-KYC acquisition. Second, you run those coins through a Whirlpool coin joint to effectively shatter any links to their past history. Third, you utilize post-mix spending tools like Stonewall to retain that privacy moving forward. And finally, you secure the bulk of your funds entirely offline in cold storage.
Furthermore, achieving true technical sovereignty means you have to run your own infrastructure. You can use great plug-and-play packages for this, like Ronin Dojo or Umbrel. So the absolutely crucial point to take away here is this. If you don't run your own node, your transactions are passing through someone else's node, and that node could easily be operated by chain surveillance firms. Running a node means you verify your own transactions without trusting anyone else, period.
Which brings us to the absolute pinnacle of self-custody, multi-sig vaults. This is an institutional-grade security setup requiring multiple private keys just to authorize a single spend, which effectively removes any single points of failure from your security architecture. To actually see this in practice, let's look at a collaborative 2 of 3 setup offered by Unchained Capital. In this model, you hold 2 hardware keys in completely separate geographic locations, backed up by metal seeds, while Unchained holds the 3rd key. But here is the ultimate key to your sovereignty. You hold what's called a wallet descriptor file. It's essentially a treasure map to your keys, meaning even if your provider disappears completely tomorrow, you have the interoperable tools to recover your funds yourself. You can literally never be frozen out of your own money.
Moving into Section 4, Dual Repeated Shadowing Drills, Building Automaticity and Prosody.
So, how do we learn to speak like this automatically? Shadowing. It's the practice of repeating a native speaker's words with minimal delay to build automaticity and that authoritative tone or prosody of a financial leader. As you review transcripts or case studies, I want you to follow these 4 specific phases. Phase 1 is silent observation. Literally, just listen closely for stress and intonation. Phase 2 is subtitled shadowing. Read the text and repeat it simultaneously so you connect the spelling directly to the sound. Phase 3 is non-captioned shadowing. Take away the text, rely purely on your ears, and mimic the sound. And finally, Phase 4, content synthesis. Summarize those complex technical mechanics in your own words.
This shadowing process directly facilitates our major vocabulary shift. Just notice how the beginner's phrase, Internet of Money, transforms into the professional's peer-to-peer consensus network. The simple private digital vault elevates up to self-custody and multi-sig security. And something as basic as mining for coins matures into energy-intensive hash rate consensus.
And that brings us back to Phase 4, which is all about taking a pause. Step back from the intense repetition for a second, let the concept steep, reflect on the core narrative, and start to creatively synthesize that relatable human element of iteration A with the hard, highly precise data of iteration B.
Finally, Section 5, Actionable Financial Storytelling, Driving Business Outcomes.
Because, let's be real, the ultimate goal of all of this is to synthesize the underlying philosophy and the hardcore mechanics into a presentation that actually drives real business outcomes. Pure data alone just isn't enough. It has to be wrapped in a compelling narrative for people to care. So I'm going to leave you with this question. Are you ready to step into the boardroom and truly shape the financial conversation? Because by anchoring your insights in relatable storytelling, while simultaneously commanding the precise technical mechanics of the digital asset frontier, you officially transition from a passive participant to a definitive leader. Thank you so much for joining me in this explainer today, and I absolutely cannot wait to dive into our next topic with you.
Let's dive right into this explainer and save your next valuation from a total disaster.
Never use the country of incorporation for your market risk premium.
You must always use the country of operation, or your cost of equity is completely wrong.
Seriously, this simple geographic mix-up totally derails your NPV and WACC calculations.
Think about it. This premium is the extra return investors demand for bearing on-the-ground market risk. The fatal trap? Prioritizing a paper registration over the physical reality of where business actually happens.
Let's look at a real-world scenario using WACFinder to see exactly how this plays out.
Business registered in Singapore, but your paying customers are in Indonesia? You pick Indonesia.
You got to account for the real localized risks of the jurisdiction actually generating the revenue.
Ignoring this specific country risk artificially shrinks your cost of equity and dangerously inflates asset values.
Getting this geography right is absolutely key to generating bulletproof, reliable fair value calculations.
Stop failing your estimates. Grab my paid FM notes.
Welcome to The Explainer. Let's dive right into today's topic, financial nihilism and the shame spiral. Earning a solid paycheck but still feel totally broke and priced out of your own future?
You're not alone. Turns out most money problems are actually deeply emotional way before they're mathematical.
It's a modern paradox, really. Even so-called affluent Americans are living right on the financial edge.
Harvard research shows that having cash seriously reduces stress and gives you a vital sense of control.
But lacking it triggers the shame spiral. That's when you internalize deep, personal blame for financial struggles.
We've completely normalized the idea that financial scarcity is your personal failure, so you just avoid it.
This completely ignores the massive systemic hurdles we've built that actively work against you every single day.
Look at this, $94,000. That is the average debt load absolutely crushing Gen Z today. The old rulebook, save slowly, buy a house, it just feels entirely broken in our new high inflation reality. This breeds financial nihilism, which is basically the growing belief that traditional paths to stability are gone. When inflation eats your entire paycheck and housing is out of reach, slow and steady feels like a scam. Feeling left behind? Younger investors are chasing much faster outcomes. We're talking high-risk crypto, sports betting, meme stocks. They are even turning internet culture and daily doom scrolling into actual high-stakes market research. Wild, right? Actually, 80% of Gen Z traders drawn to this stuff say conventional wealth building is just hopelessly slow. So let's shift the paradigm. We have to stop internalizing failure and start recognizing these massive systemic roadblocks. Breaking the shame spiral takes real systemic change. Another personal budgeting app just isn't going to cut it. Harvard researchers pose a fantastic question. Why is having control over your life a luxury only for the rich? We absolutely have to restructure our institutions so they empower everyone, no matter the size of their paycheck. So, what do you think? Are you ready to stop taking the blame for a fundamentally broken economy?
Welcome to This Explainer. Today we're diving straight into a fascinating mental trap that catches almost everyone, the emotional weight of sunk costs. We're going to explore exactly how this psychological hurdle derails our everyday decisions, and, more importantly, we're going to uncover the precise frameworks that top CFOs use to break totally free from bad investments. If you've ever found yourself holding on to a losing hand just because of what you've already put into it, well, you're definitely going to want to stick around for this.
Okay, let's kick things off with a situation I think we can all relate to. Imagine you're 10 months deep into car payments. You've been diligent, but the thing just keeps breaking down. First it was the brakes, then the transmission, and now it's making some mystery clanking noise the mechanics can't even figure out. The stress of that debt plus these constant, unpredictable bills is literally starting to weigh heavy on your bank account and, let's be honest, your sanity.
But you just keep paying for the constant repairs. Why? Simply because you've already spent so much money on the car. You think to yourself, I can't quit now, I literally just put $2,000 into the engine last month. It's a classic, everyday financial trap, a total cash flow black hole. And it happens because you're looking backwards at the money you've already spent instead of looking forwards at the reality of your current situation.
Now, in behavioral finance, this has a specific name. It's called the sunk cost fallacy. Basically, it's the totally irrational habit of continuing an endeavor based purely on previously invested resources, whether that's time, money, or emotional effort, that absolutely cannot be recovered. Essentially, our past unchangeable expenses illogically dictate our future choices. We basically become prisoners to our own financial history.
But why do we do it? Well, the psychology behind this is just fascinating. Commentators point out that walking away is incredibly tough, because honestly, our ego and pride get in the way. There is immense psychological pain in unwinding a failing trade or admitting we made a mistake. Sometimes it's driven by greed or even a desire to maintain a new normal lifestyle we feel we've earned. These emotional triggers trick our brains into keeping a failing strategy alive, constantly whispering that success is just one more repair or one more investment away.
Section 1. The corporate reality, elevating to the CFO level.
So, let's zoom out to the macro level, because here's a wild truth. This exact same emotional dynamic plagues multinational boardrooms too. Executives are human, right? They fall in love with failing projects all the time because of the millions they've already poured into them. To fix this, ACCA professionals use a concept called relevant costing. It's a cold, hard, heavily tested accounting rule that forces leaders to completely ignore the past. It strips the emotion and the ego right out of the boardroom and replaces it with pure, objective data.
The crucial takeaway here is that if you want to make a sound corporate investment decision, you have to follow 3 absolute non-negotiable rules. The only costs you are allowed to consider must be future, they must be incremental, and they must be actual cash flows. If a cost is in the past or if it's a non-cash accounting entry like depreciation, it is mathematically dead to you. You simply cannot use it to justify your next move.
This perfectly illustrates the divide between a rational CFO and an emotional investor. Check out the left side. Opportunity costs, the value of your best alternative, and avoidable fixed costs, those absolutely matter. But look at the right side. Historical sunk costs, committed capital, depreciation, completely irrelevant. The money you spent on that car engine last month, irrelevant. The millions a company spent researching a product nobody wants, irrelevant.
When it comes to actually evaluating failing projects, CFOs execute this really clear three-step shutdown decision framework. First, calculate the contribution that'll be lost if the project closes. Second, calculate the avoidable fixed costs that'll be saved. Finally, shut down the project if those avoidable savings exceed the lost contribution. Notice what's missing from this list: historical capital expenditure. It completely removes the ego from the equation.
Section 2. Phase 2, subtitled Shadowing, Building Linguistic Automaticity. To really bridge the gap between everyday psychology and high-level corporate finance, we're going to use a dual iterative shadowing framework. Research shows that transitioning from simple, relatable stories to high-level terminology helps build linguistic automaticity, which is basically the ability to speak with authority without hesitating. So we'll alternate between plain English story expressions to lower the cognitive load and their boardroom professional expressions. By shadowing these aloud, you can practice speaking with that precise financial authority.
Let's start with our first scenario. Go ahead and read the text on screen and repeat this super relatable story expression out loud with me. I've spent too much money on this broken car to stop fixing it now. This right here is the voice of emotional finance. It's the exact feeling of the sunk cost fallacy in our daily lives.
Now let's swap to the boardroom equivalent, the objective voice of the CFO. I'm going to repeat this expression exactly 2 times for you to shadow simultaneously with me. Ready? We must exclude historical capital expenditure from our relevant costing analysis. We must exclude historical capital expenditure from our relevant costing analysis.
Excellent. Okay, let's try the second scenario. This is transitioning from the trap into the actual solution. Starting with our everyday story expression, repeat it with me. Let's just sell the broken car for whatever cash we can get. This is that key moment of acceptance where rationality finally overcomes pride.
And now, we elevate that straight to the executive level. Shadow this professional expression with me, repeating exactly twice. We should exercise the option to abandon the project and realize its salvage value. We should exercise the option to abandon the project and realize its salvage value.
You did fantastic with that. By grounding complex theory in familiar stories, we don't just learn the vocabulary, we internalize the mindset of a rational financial leader. Wrapping up this explainer, I want to leave you with one absolutely vital question to ponder regarding your own decisions. What failing project, or, broken car, are you holding on to for entirely the wrong reasons? It just might be time to exclude your historical expenditure, exercise your option to abandon, and finally move forward.
Did you know a crazy, profitable company can still go completely bankrupt?
Yep, it happens. How? Simple. Profit and cash are absolutely not the same thing. Not even close. Profit is just an accounting concept on paper. Cash flow? That's your actual cold, hard cash. And this is the exact trap ACCA examiners use to trick you on test day. Make a credit sale, and profit shoots up instantly. But your bank account? Still totally empty. So remember the golden rule: profit is accounting, cash is reality. Never mix them up. Grab my PDF notes to pass FA. Seriously, you literally can't afford to get this wrong. Hello and an absolute enthusiastic welcome to this explainer. Look, if you're a focused learner trying to figure out how to maximize your efficiency, you have landed in exactly the right place. Today, we are talking about a totally monumental shift happening right now in the finance world. We're going to explore exactly how CFOs and FP&A professionals, financial planning and analysis folks, can use AI prompt engineering to reclaim their time and literally skyrocket their strategic value. And we're not just talking about abstract theory here. We are getting right into the weeds with actionable frameworks you can start using today. To really understand why this is so absolutely critical, I want you to consider this staggering number: 60%. Right now, as we speak, FP&A professionals are spending up to 60% of their entire week on routine data collection and formatting. I mean, think about that for a second. That leaves a mere 35% of their time for actual, high-value analysis and strategic guidance. It is just a massive, massive misallocation of top-tier talent. But here's the good news. By leveraging AI as a highly structured, time-saving tool, finance teams can fundamentally flip that equation on its head. Using the strategies we're about to cover, you can reclaim at least 5 hours per week of mind-numbing manual work, finally pulling yourself out of that relentless FP&A time trap. Just imagine what you could do, or the insights you could uncover, with an extra 5 hours every single week to focus on the strategic work that actually gets you noticed and promoted. Okay, so here's our roadmap for today. 1, we'll hit the FP&A time trap. 2, we'll dive into the CRO prompting framework. 3, automating variance narratives. 4, the art of financial storytelling. And finally, 5, we'll look at the AI-powered CFO of 2026. Let's kick things off with Section 1, the FP&A time trap, navigating the automation pressure. I want to ground our entire conversation today with a fantastic quote from Didi Gerfinkel, the CEO of DataRails. He says, AI is not replacing the CFO's office, it is redefining it. And that really hits the nail on the head, establishing the immediate stakes here. AI is absolutely not an outright replacement for human judgment or your deep, hard-earned business knowledge. It's a tool for evolution. The professionals who are going to thrive are the ones who figure out how to combine AI fluency with their existing strategic thinking.
And just look at what's happening if you don't adapt. Based on some fascinating 2026 reporting from DataRails, CFO salaries are actually up 9%. But get this, controller salaries are down 21%. Meanwhile, a massive 43% of FP&A job postings are now explicitly requiring AI skills. The market is aggressively concentrating financial value at the strategic top, right? And at the exact same time, it's applying intense, heavy automation pressure to operational and reporting roles. You simply cannot afford to just be a human calculator anymore.
Moving right along to Section 2, the CRO prompting framework. Context, reasoning, output.
So whenever you prompt an AI, you absolutely need to hit all 3 parts of what we call the CRO framework. Step 1 is context. Who exactly is the audience and what is the goal? Step 2 is reasoning. What's the underlying logic and the specific tone you need? And then step 3 is output. What specific format and constraints do you have? You really have to treat AI as your co-pilot for language and structure. But, and I cannot stress this enough, it is never an autopilot for arithmetic.
Let's rapid fire through some pro prompting tips straight from the FP&A community trenches. First up, specify your audience. Writing for a VP of engineering is an entirely different ballgame than writing for a CFO, right? Second, and this is so vital, paste the actual numbers. Don't use placeholders, give it the messy, ugly table. Third, and this is the golden rule, never ask it to calculate. AI models confidently produce completely wrong math, so pre-compute your numbers in Excel first. Fourth, give it specific tone instructions, like say, make this accountable but not defensive. And lastly, iterate in the same chat window. Actually, don't start over if it's slightly wrong. Just tell it, hey, make it 30% shorter and let it adjust. All right, Section 3, automating variance narratives, putting the framework to work. The entire difference between a huge success and ripping your hair out in frustration comes down to your prompt structure. A bad prompt just basically asks for a template with a blank space for a number. And what does it give you? Generic, useless fluff. But a good prompt uses the CRO framework. You paste the actual raw, messy Excel table right into the chat. You explicitly tell it the audience is the board of directors, and you constrain the output to exactly 3 bullet points. That is how you yield a tailored, highly specific, actually useful first draft. And the return on investment here? It's immediate and it is tangible. By using these structured prompts, you can generate a variance narrative first draft in 2 minutes instead of, say, a manual 35 minutes. Over the course of a month, you've just saved 45 minutes right there. What about automating that really complex bridge to budget explanation? Boom, that saves an hour and a half. Generating the skeleton for your quarterly business review? There's another 45 minutes saved. Keep this in mind, the prompt itself becomes your valuable asset, and the output is just a byproduct. Okay, let's jump into Section 4, the art of financial storytelling, beyond the numbers. Consider the massive difference between raw data and an actual story. The raw data might just flat out say, operating expenses rose 17%. Okay, sure, that's a fact, but honestly, it's a dead end. A compelling story, on the other hand, says, OPEX rose 17% due to supply chain delays, but we can reverse this trend by renegotiating our vendor contracts. See the difference? The story creates clarity, it gives direction, and it builds confidence. It contextualizes the insight so the audience actually understands what the heck they need to do next. Now, you know as well as I do that finance is just full of jargon that makes non-finance stakeholders' eyes completely glaze over. EBITDA margin compression, that might mean something to you and me, but to the marketing team, it's totally abstract. But here's the magic. You can prompt your AI to act as a specialized translator, turning that dense jargon into plain language analogies. Suddenly, EBITDA margin compression becomes, hey, our profit per dollar of sales is going down. It beautifully bridges the gap between those abstract spreadsheets and tangible, everyday reality.
Finally, Section 5, the 2026 AI-powered CFO, from reporter to value creation engine.
So if we look at the JDocs maturity model, a lot of really good teams today are currently sitting at stage 3. They are strategic advisors. They provide advanced scenarios, they write solid decision memos, and that's great. But stage 4? That's the 2026 target state. That is the value creation engine. Here, FP&A isn't just sitting in the back writing memos. They are actively running live decision simulations during leadership meetings. They are proactively helping leaders pivot and act before those outcomes are even locked in, directly influencing growth and margins in real time. It is a complete game changer.
But to actually reach that elite stage, certain things are just becoming table stakes. Static, once-a-year annual budgets? Honestly, they're dead. It's like trying to drive on the highway by exclusively looking in the rearview mirror. The new standard is absolutely continuous, driver-based planning. It involves using digital business twins. It's relying on human-governed AI embedded right into your everyday workflows. And crucially, it's the integration of external market signals. Because let's face it, if your internal forecast ignores what's actively happening outside the business, it's basically obsolete the minute you hit publish.
Well, we've covered a massive amount of ground today, right? From the heavy automation pressure squeezing operational roles all the way down to the practical CRO prompting frameworks that can literally win back hours of your week. AI is rapidly moving from a fun little experiment to a deeply embedded workflow, and it absolutely demands that we adapt. So, looking at this rapidly evolving landscape, you have to ask yourself, are you going to remain a spreadsheet dweller, just crunching numbers, or are you going to step up and use these incredibly powerful tools to become a true strategic advisor? The choice, and frankly the prompts, are completely in your hands. Thank you so much for joining me for this explainer, and keep learning.
Listen, whatever you do, never try to question Spot.
In your AFM exam, it's a huge trop. The reality is, literally any topic can come up
in absolutely any part of the exam.
So, you really must get a solid coverage of the entire syllabus.
Need help? Go download my paid AFM notes right now.